Okay, opening up the pronouns. Okay, just closing up. Okay, folks, first off, it's standing room only, so I hope this is going to be a good one. If you could all try not to move around during this debate, there are a huge number of people in here, and the most important thing is that we can hear what the speakers are saying. The more attentive amongst you will have noticed that I am not, in fact, Buzz Skybox Klinger. There has been a switch in this panel, so now we have myself, Michael Dungoption in the chair, judging with me, Adnan Mukhtarib, Bobiandika Ruatang, Vinu Goswami, and Andrew Shea. In opening government, please give a big round of applause for UTMARA. In opening opposition, IIT Bombay A OO. In closing government, Yale A. And in closing opposition, Tel Aviv A. Okay. My phone will do the timing. We'll have a ding after 1 minute, a ding after 6 minutes, a double ding after 7 minutes, and after 7 minutes and 15 seconds, my hands will go up and I will stop typing. The motion before the House is not on the ballot. This House believes that all governments should designate and publicly announce a list of all financial institutions that they would bail out in the event of a crisis. Without further ado, call upon the Prime Minister. Here.
Ladies and gentlemen, from opening government, we aim to ensure that we have stable financial institutions, will be able to prevent crisis and incentivize the appropriate response in the event of a crisis or approaching a crisis. So our model is simple. We'd like to announce a list of all financial institutions that we're willing to bail out. We will levy all regulations possible on these financial institutions, things like having banks having higher liquidity standards, no predatory policies, and so on, have more scrutiny on these financial institutions. We do say that these institutions, this list is a list that where institutions can be kicked off the list if they don't follow the regulatory standard that we impose. Who are these financial institutions that we're likely to stand by bailing out? We're probably talking about big banks. Unfortunately, the undeniable reality that some big banks are just too big to fail and are just central to the economy, those are probably banks that we're talking about. And are ones that are able to provide financial muscle, resilience, and reliability that most countries in the world rely on today. We stand by an OG that a large bank in on itself is not a bad thing, but it's the unpredictability and irresponsibility of financial institutions that's bad that we intend to deal with. We have three objectives from my speech. Two objectives, sorry, couldn't count. So number one, how do we incentivize more responsible practices for financial institutions? Number two, how do we deal with the instance in which either a crisis occurs or a crisis is about to occur, and how do we incentivize an appropriate response then? So number one, how do we incentivize a more responsible practice? No, thank you. So number one, we think under status quo, either all big banks or most financial institutions presume that they will be bailed out approaching a crisis. Why? Because there's no clear line as to a visible clear line as to how central each institutions are, yes, how central they are changes all the time. So this means that it's incredibly irresponsible for some financial institutions to presume they will be bailed out and then have predatory policies that are bad and exploit individuals and the economy. We also think that most financial institutions sometimes think of short-term profit rather than stability. For example, all the problems that happen approaching the financial crisis, recession, all caused by irresponsible banks who are over presumptions. So how do we change this? We think number one, we have a clear signaling to multiple banks as to the stability of their banks. So that means that small and medium banks have set expectations that they might not be bailed out in the event of a crisis. That means that they might be prepared. They might be prepared to not obtain a bailout. The impact is that most of these small, medium financial institutions might have less predatory policies. They might be a lot more responsible during times approaching crises and be very prepared. So we think it's very important. I'll take a clarification closing.
Yeah, so can you please define if you are going to be able to consider that how they can spend the money after the risk, not only what is the condition to be on the risk?
So we think that after they've been bailed out, it's very important that they also spend the money responsibly. What we mean is that very importantly, towards the recovery of their financial institution, recovery of the economy, and so on, we think it's also very important, right? So how do we change banks that we protect and will bail out? So we think that banks that are very important that we claim to protect and bail out will put a market and political spotlight on these financial institutions. That means that there are a lot of people watching this financial institution, ensuring that their policies are good, their policies are not predatory, and indeed lead to market stability. We think it also, number two, changes political incentive to ensure that politicians pay a lot of attention to the regulatory manners in which this financial institution operate. We don't think this is present under status quo, in which a lot of politicians sometimes are either in bed with this financial institution, turn a blind eye to the policies that they have, some of which are not good. And we think this provides an expectation on all politicians to pay attention to all of these financial institutions. And number three, this also justify extremely restrictive financial regulation, particularly on these financial institutions. We think it's very important because sometimes restrictive financial regulations may be unpopular for some individuals or unpopular for people who are pro-business. But we think having a government telling us that it's important to have these restrictions, because at the end of the day, without these restrictions, we might have to bail them out. It justifies all of those very, very harsh restrictions, which I think are really important to maintain market stability. But what do we also create when it comes to crises? We think we create predictability and certainty in the market, one in which we think is largely absent in the market today. We think that when there is a crisis approaching or a potential crisis, it creates a market panic in which a lot of people either pull out money out of big financial institutions, investors largely leave the country, leave the financial institutions, a lot of people pull out money, don't want to buy stocks, bonds, and so on. This ties into how this impacts the entire economy. Realize that a financial crisis doesn't have to happen, but have to be approaching for people to also have to pull out all those things, which doesn't help the financial crisis, but actually leads towards the exacerbation of that particular situation. We think it's a cyclical problem that we intend to prevent. So if there's a government bailout that creates some certainty that won't create a market panic, that means it's easier for the government to deal with that situation, as opposed to bail them out somewhere later when the things are unpredictable and much harder to bail out in the future. So we think that at the moment, we won't create a market panic that makes it so much harder to deal with. No, thank you. We think in comparative, it'll be much hard, a lot of things will be much more unpredictable. Market panic will be worse. No, thank you. So we also have, lastly, certainty to how financial institution will respond. So we think particularly these financial institutions, all your big banks that we're talking about, that we are planning to bail out, so usually approaching a financial crisis, they'll also intend to prevent a financial crisis or prevent a downfall of their bank, do things sometimes like divest or pulling money out of them, pulling money out, or do very, very bad things that impacts consumers, like bank closing down, bank refusing to dispense money, hike up interest rate, all those things that largely impacts consumers. This is very dangerous because the moment in which a big bank does that, and a lot of people either can't get access to their money or realize that a bank is closing down or a bank have divested a lot of their money, it either impacts the way in which small businesses work, impacts the way in which large businesses work as well, and largely impact consumers and their ability to buy things in a moment approaching crisis, and creates panic to how people spend money as well. If people realize that tomorrow or next week they might not be able to have access to their money because one bank decide to close down and not dispense money, this creates panic in a lot of consumers, and this lowers demand which means that it's much harder for the economy to recover at that point in time. We think it's really bad. At the end of the OG debate, we think we've proved to you that at least on our side, we have market predictability, certainty, and we ensure we don't have a market panic. We are extremely proud to propose.
Thank you very much. And now the leader of the opposition. Here, here.
IIT!
The logic of opening government's case. All banks that matter presume they'll be bailed out anyway. And the solution to that is to ensure that they know that they'll be bailed out anyway. Because we think right now, banks have multiple reasons to believe that they might not be bailed out. For example, how the public is going to react at the point at which they know, or that the point at which they do fail and the public might not want them to be bailed out. How, like, which government is in charge, for example, might mean that they might not get bailed out. We don't think that's a certainty. Now they know for sure, right? We're willing to stand by on opening opposition, having like in the case that a bank is so important and they do fail, then maybe post facto bailing them out. We are okay for people if they really want to make safe investments, having like investing in things like US Treasury bonds, which are safe, for example. Thirdly, if liquidity standards is so important, we think we should be doing it anyway. We think if like there's enough incentive already for companies, for countries to ensure liquidity standards given all the crises that happen. Also, for example, like to prove that point, like the US government is really pushing Deutsche Bank hard because they keep failing to meet liquidity requirements year after year, right? Moreover, we think this, and this is in response to this idea of they will now pay large attention, right? Given that the amount of resources are constant, the trade-off is they'll probably not pay attention to banks not on the list. We're not sure why that's a benefit, given they'll give like risky behavior according to them happens anyway. On this idea of market panic, and this is my only extraneous rebuttal, we think firstly, like cycles in the economy happen. We're not sure why that's a bad thing, but we can try and stop market panic, right? We can try and like invest in those banks. We can try and prevent them from from withdrawing money from the ATM. But like we are okay think that like sometimes market panic will happen, and we're okay with trading that off because like we think in the long run the harms in terms of the incentives to banks are much worse, and we're willing to concede to some degree there will be short-term market panic, and we will trade that off. Okay. Firstly, on how are these likely to be picked and why that's a problem. And secondly, why on the fact that companies take too many risks and now that gets worse. Firstly, how are these banks likely to be picked? Hillary Clinton's biggest financiers were Wall Street. There was Morgan Stanley and it was like Goldman Sachs, for example, right? I think lobbyists often have lunches with people in politics. You think politicians have to pander to them because their careers depend on it, because they need money for campaign, right? So even if we think that it's a good thing, even if we concede all of that, we think the way you pick it would be unfair, because now lobbying gets, secondly, much more pernicious, because you have a huge profit incentive now to lobby to politicians. You have a huge incentive to ensure that they put you on that list, because as they claim, that list is so important to you. Moreover, given that you are now a secure company, you get a lot of customers, right? You get a lot of customers who know that they won't lose money if they put their money in your company, right? Which means that the people who are on this list have an unfair, uncompetitive advantage over people who are not on the list, because like you're going to get more customers just because of the fact that you were on this list, right? Which means that lobbying and the way these companies are picked are unfair to other companies who don't get picked. That gets much worse. We think, secondly, companies take too many risks, and now that gets worse. Firstly, under this, what happens now is that big companies like who are going to be on the list will be assured of customers. We think what happens now is people will go to them because they're scared of losing their money. What happens now is that you have worse interest rates because these companies know that they can charge you higher interest just because they're on that list, right? Moreover, on this idea of worse interest rates and more bad loans, the only way smaller banks can break into this big bank criteria is by competing on interest rates. So smaller banks take smaller margins and give smaller interest rates, and then give small better interest rates, and that's how they manage to compete with bigger banks. What happens now is the bigger banks who make this list will, despite the fact that they have worst interest rates, continue to get customers because the customers see that as safe. We think this is like not only like bad, a really bad deal for a lot of people who want loans, being forced to take a bad loan just because you're on a list that a government defends, right? Secondly, on risky endeavors and why that gets much worse. We think, firstly, in terms of the way these companies work internally, often traders get off on big wins. We think often like their promotion is linked to the fact that they can make risky investments that have big returns, right? We think often like this means that even though they have indicators for risk, we think risk versus return, these indicators firstly aren't really very good. Often they're based on things like historical data, which is not really reliable. Secondly, they're based on things like political swings, which you really don't know will happen. Thirdly, that it makes certain assumptions of how people are likely to behave, which isn't often reliable in the first place. We're not sure, we don't think these indicators that companies have for assessing risk of loans are particularly good. But what happens now is that like when you have this risk versus return ratio that these companies see, it becomes much more likely for traders to take higher risk investments, higher risk. So they're more likely to invest in things like speculative markets. They're more likely to give like bad loans and give loans despite not having much collateral, for instance. They're less likely to have oversight on these kinds of loans because they know that in the case that these loans do turn out successful, they have a lot to win. And in the case they don't turn out successful, they don't really have much to lose because they'll get bailed out anyway. Note that the money that's at risk is the people's money. It's the money that people have invested from like hard-earned savings into their own bank accounts. These are the money that's getting diverted and being used in these endeavors, right? But secondly, note that the money that goes from the bailout is also people's money. It's also tax money. So you're taking all of that, giving them in the hands of already risky actors and increasing the risk on your side of the house. I'll take closing.
You say it's unfair for unsafe banks to have to pay a higher interest rate. Interest rates are literally supposed to communicate the risk of your investment. Why should I not get paid more if it's a really good chance that my deposit is going to disappear in a year from now?
Which is why we think big banks already have higher interest rates, and that's why people invest in them despite that. The only way for small banks to compete is give lower interest rates. Now, the only reason someone will go to your bank is because you made a list probably by lobbying, and that's unfair to small banks. We're not sure why that stands, right? More on risky endeavors. We think moreover what companies are now likely to do is push for more, like giving corporations more finance, which is risky. Big corporations and big startups that take huge risks which might have huge returns, right? We think like given that more than 14 out of 15 startups fail, that's much more likely for companies to flood money into that and take up these risky investments because CEOs know that their jobs aren't on the line. They know that the fact that they are like even, and that means the people below them know that they are allowed to take risky investments, and CEOs are less likely to check them when they take risky investments. If the government's problem is the fact that banks make really bad investments or give really bad loans and have very high interest rates, that's much worse on your side of the house, and it tramps down on those people who actually help whose money actually matters more to them, as opposed to like traders for whom the money of these people matter much less. On our side of the house, companies don't know if they're going to get bailed out. They are likely to take less risk and they actually follow the criterion which is important for the average people. We're very proud to propose.
Thank you very much. And now the Deputy Prime Minister, here.
Ladies and gentlemen, I'm going to divide my speech into two segments. The first is what kind of behavior can we expect from financial institutions leading up towards a financial crisis? And secondly, what kind of behavior can we expect or be certain of when it actually hits, and how do we deal with it then? Firstly, and my rebuttal will be integrated, I promise. The first is, let's talk about their behavior leading up to a financial crisis. The first thing that we claim from the opening government is that most of the time financial institutions either expect a bailout, number two, don't even think about it because of a profit incentive in order to pursue short-term gains to the expense of long-term sustainability. And thirdly, ladies and gentlemen, right from the concession that came from the leader of opposition that banks has a horrible ability to assess risk, not only by themselves, but also for the rest of the market as well. All these characterizations never dealt with from the leader of opposition. But the reason why the expectation of a bailout or the irresponsible behavior was especially important in this particular debate is because there was no mechanism in the status quo to ensure that those things would be dealt with in the status quo. Sure, if they will have to best case scenario and have all their regulatory standards, higher liquidity standards, all the things that they want to talk about on that side of the house, the market as well as these financial institutions would still not know what would happen in the instance where a massive financial crisis hit and fundamentally the market crashed, ladies and gentlemen. Notice the financial crisis isn't as something as simple as, for example, I misplaced $20 and that's a problem for me, ladies and gentlemen. Literally, the world is burning all around you, and whatever financial situations or, for example, regulatory stance that you had probably failed in that particular circumstance. Yes, we can have those things, but we need to know what happens when things fundamentally break down, and that's the fundamental thing that hasn't been engaged with on the opposition bench. But secondly, something that we told you why it would increase our ability to have all the regulatory standards that they wanted, as opposed to just fiating as the leader of opposition wanted, is that we place political spotlights on these particular financial institutions when they would have otherwise been invisible and be able to game the system in the dark, ladies and gentlemen. Just like the leader of opposition said, that most of these politicians are in the pockets of these financial institutions, and probably the ones that are too big to fail are probably the ones that are the most best in place to be able to game the system in order to have some sort of assurance they'll be able to have a bailout when a financial crisis hits. The problem with that, ladies and gentlemen, is that in the meantime, they'll be able to game the system as much as they want, ladies and gentlemen, and the rest of the system, the rest of the consumers, because obviously you can't advertise to people, right, that you've gamed the system in order to obtain a bailout. In that particular circumstance, we think it's far more likely that you have the very same institutions still getting a bailout on your side in their best case scenario. But the problem and the comparative is you're less able to dictate the terms that are favorable to you in those particular circumstances. Because in a time of financial crisis, you're probably coerced by a world burning around you, and you're probably trying to save yourself from 800,000, 80,000 jobs, or whatever the number was during the financial crisis, lost every single month, ladies and gentlemen. And you're probably pushed by political pressures by your constituencies, as well as your political parties, and loss of favorability to concede to any sort of demand that these financial institutions push on you on that particular circumstance. So Goldman Sachs is probably very conveniently going to game the system right now. When they fail, ladies and gentlemen, sorry, Michael, when they fail at the end of the day, they're probably going to still expect a bailout, probably going to get in, probably going to get golden parachutes all around, because the government isn't able to stand the test of scrutiny. In the comparative, at the very least, we'll be able to dictate terms and at least lay down standards that weren't able to do before on that side of the house, ladies and gentlemen. Leverage isn't in the hands of the offender, at least under our side of the house. But secondly, ladies and gentlemen, in the meantime, at the very least, now, in a bit about interest rates. I'm no expert in economics, so I won't pretend to know a lot, but this purely on logic. I'll deal both, so in case I'm wrong, I'm still right? So first, in the instance where you're talking about interest rates, thank you, Evan, I think she gave me a little bit of inspiration, is that in the instance where you're, for example, having a bailout means that your financial investments are a lot more secure. I think that's a reason as to why interest rates go down as opposed to going up, ladies and gentlemen, because the risk significantly decreases in that particular circumstance. But on the converse, in case I'm wrong about economic logic, ladies and gentlemen, I would think that the very same thing that the leader of opposition says in regards to small to medium financial institutions offering instead low interest rates in that particular circumstance offers the very same competition that drives down those large financial institutions going down as well. Furthermore, we would also say that large financial institutions also compete among themselves as to being competitive in regards to their financial interest rates as well. Because, ladies and gentlemen, sure, those large financial institutions can probably offer you large interest rates, but you're not going to take them up at the point where it costs you money to actually take up that loan, rather go to another financial institution on that side of the house. So what can we conclude from that first issue, ladies and gentlemen? That most probably you have absolutely no certainty whatsoever as to what happens when things fail. And notice the terminology of crisis means that it's unpredictable, ladies and gentlemen, and we'd rather know what we can do to get out of it rather than leave it to the whims and fancies of the most powerful and has the biggest financial muscle on that side of us. Before I go on to the second issue, yes, sir.
Why are companies who made bad investments failing a bad thing compared to giving them a ticket to make worse investments?
Yes, but I just prove why the political spotlight may lead to not doing that, ladies and gentlemen. But even if it does, even if it leads to them believing that they are invincible, ladies and gentlemen, their competition drives it down. But fundamentally, that's comparatively better as opposed to a world crashing and you not knowing and the financial institutions being able to take control over that system. You still have to prove why the comparative is worse in comparison to this, ladies and gentlemen. But secondly, now what happens after? Because I think a wealth of the analysis that came from Jasmine's speech literally went conceitedly unresponded, because they just said, okay, we're willing to bite that cost without actually ever responding to those harms, ladies and gentlemen. But notice, we went a step further by saying it's harder to bail out once contagion has already hit, ladies and gentlemen. That means consumers have already lost their jobs, their homes, their money, ladies and gentlemen. And fundamentally, it's harder to recover that money. It's harder to recover faith in those particular institutions and harder to recover faith in the market for that particular circumstance. Panic as well as market reactions is not something that you can control with an on and off switch on the opposition bench. A market oftentimes reacts disproportionately irrationally. For example, the election of Donald Trump led to a raise in stock prices in America because people thought that, you were going to spend more money on, I don't know, steel and bricks because the wall was going to be built, right? In that particular circumstance, I think it's actually prudent in this circumstance to be able to say that don't let the contagion hit and let markets expect that these losses will be taken, as opposed to trying to reel in those particular recovery once the damage has already been done, ladies and gentlemen. When lives have been ruined and when things have already been lost, it's a little bit too late to tell the people and tap them on their fingers and tell them that they did something wrong, ladies and gentlemen. Before the most vulnerable are hurt, we will rather tell them how they are best able to be protected by the state as most able to. Thank you very much.
Thank you very much. And now the Deputy Leader of the Opposition. Here.
Right. Let's quickly look at why opening government falls out of this debate, right? They wanted to do 4 things by the end of their speeches. Let's tackle them one by one before I go into my constructive about why this move is inherently anti-competitive and leads to the entrenchment of the interests of big banks in a way that small and medium-sized banks can never break the cycle, right? But let's just dispose of OG right up front, right? First, the first outcome that they wanted is that they wanted to prevent crisis from happening in this particular debate, right? Look, here's the thing, to the extent that crises are always going to happen, this is something that everybody in this room knows. Why is that the case? Because the economy works in boom and bust cycles, and there are things that are outside everyone's controls, which means things like political elections or things like natural disasters, earthquakes or conflicts, etc., which means conflicts always happens. On the comparative, and we proved to you this through Leader of Opposition Substantive, that on their side of the house, these crises are going to happen much, much more because big banks are going to make much worse incentives because they never gave us any analysis to prove why is it that their incentive changes in order to stop sit down making risky. We tell you on the comparative that given a safety net and given their own analysis of how bad big banks are in their ability to assess risk, we think that they're going to continue to make more and more risky investments because now they know that they're going to be bailed out, sit down every time they fail. But what's worse is this compounds it by the fact that other small and medium-sized banks continue to follow the trend set by the bigger banks, which means that if big banks are investing in particularly bad and risky endeavors, the market often reacts in such a way that these investments are often legitimized in that small and like other banks sit down, also follow these trends, which means if these investments turn out to be risky, as they will, the only people who do fail are the small and medium-sized banks, whereas the big banks continue to profit, right? Which means that crises happen more on that side of the house. But secondly, let's deal with this issue of market panic. Sit down. Look, here's the thing. To the extent that market panic is such a problem that needs to be dealt with at the point at which a crisis hits, we think states have the ability to provide bailouts and bring the market back to stability at that point in time. Sit down. But secondly, we tell you that like existing mechanisms of providing safe havens already exist. So if your claim is that you want more safe investments and more avenues for safe investments to exist, we think that's an argument for expanding the scope of state banks, not for giving a free run to private actors whose profit goes into private hands, right? Which means it's a fundamental problem solution mismatch. Right. Let's move on, sit down to the first question of how this affects the incentives of big banks. This is the part of the debate where openings analysis has been particularly glib, right? What are the ways in which they told us their incentives are going to change? The first thing they say is, like we'll regulate them and have better oversight. Sit down. If you have the political capital to pass this move, then presumably you also have the political capital to just have better regulations and oversight. There's literally no link between giving these banks a bailout and only then like a short bailout and only then will they allow you to regulate them, right? That's literally not even related, right? But the second thing they say is, you're going to have media and political oversight of these banks, as if that doesn't exist in status quo anyway, right? You already have like a lot of actors like financial watchdogs as well as politicians who have the incentive to look out at what these banks are doing given the amount of impact that they have in society. Sit down. So they never gave us on the comparative a very, very big and tangible way to believe that any of these things are going to be comparatively better on their side of the house. What is going to be comparatively worse is the fact that banks can now continue to make much more risky endeavors because, like, by simple logic, they're going to be bailed out all the time, right? What does this mean? On the one hand, banks are able to maximize their profits because they can now go into much more risky ventures and get those big wins that leader of opposition told you about. But on the second, we think their incentive to share these returns with their customers and investors are significantly lower. And I'll talk about that more in my point on anti-competitiveness, right? By the end of this point, what we've proved is that while there is no reason to believe that there's going to be more oversight and more regulation on the action of these banks, what is going to be worse is that they're going to make bad decisions and set trends for bad decisions, which is bad for the economy, given that crises happen more often, right? But before I move on to my point about how this affects the market and different actors, I'll take closing.
Great. So you call the action of small banks below this threshold risky, but these are the very banks that don't pose a risk to the greater economy. And the type of loans you're talking about fuel small businesses, allow people to buy homes, and literally contribute to the economy actually growing, which doesn't happen on your side of the house.
Look, I'm going to tell you specifically on my second point on why this is anti-competitive, which means these very loans that you care about are given on much worse terms to these actors that you care about in this debate, right? Okay, let's talk about how, whether this affects the market, right? So, okay, we've already dealt with this idea of market panic and pulling out and why we think that can be mitigated. Secondly, let's just also quickly address this point that I forgot to about bargaining power, right? Look, when you pass this policy, you aren't setting numbers for what bailout you're going to give, right? Which means presumably when you bail them out later in terms of crisis, sit down, all of the bargaining and backdoor dealings that are going to that they have a problem with continue to happen because you still have to bargain about what that bailout is going to be. You can't foresee what that number is going to be, which means that harm doesn't stand. Sit. Okay, let's talk about why we think that this is inherently anti-competitive and why this affects the economy in general. Look, people are risk averse given that they do not want to lose their hard-earned money in times of crisis. Moreover, we think people often see crisis coming, especially in the aftermath of the 2008 crisis, where we think people want sit down to increasingly invest in safer things, right? Why does this give a disproportionate competitive advantage to big banks in this situation, right? In a couple of ways. In terms of customers, we think that small and medium-sized businesses now lose the comparative advantage that they have, where they could offer customers more attractive interest rates, whether they be lower or higher, because of the, that depends on whether we're talking about lending or saving. That's the clarification on interest rates. But okay, here's the thing, right? that comparative advantage goes away when big banks can say we are the most secure option, which means you can take whatever interest rate that we offer you, because at the very least your money won't go away at the point at which a crisis hits you, right? That's why smaller businesses get much lesser customers on our side of the house, right? But secondly, even in terms of employers who are looking for like viable long-term alternatives, now just look at like small and medium banks as feeders into big banks, which means all of the best and most experienced talent always wants to move to the big banks because the government tells them that at the end of the day, these big banks will continue to exist, right? What do we prove to you? We prove to you that you significantly harm the ability of small and medium businesses to break into the big leagues. But on the other hand, you significantly change the incentives of big banks to make much worse decisions, which means prices become like a much more everyday thing, which is worse for everyone in this room. We're very, very proud of it.
Thank you very much. And now the member of government here.
Cool. OO's case in this round was corrupt Hillary in bed with the big banks. Those big banks will always do bad. In other words, OO's case, I think, reads like a Donald Trump tweet, and in one word, it is sad. We will do 3 things. First of all, is explain why prevention is much better on our side of the house. Second of all, explain why solution to crises are much better on our side of the house. Finally, third, explain the benefits, massive to accurate pricing, rebuttal, integrated. First then, on prevention. Again, as I said, OO's line to this is just that big banks will always do bad, and they do things like set bad trends. To this, we have a number of responses. First, let's talk about, on our side of the house, an important sorting of banks that we think occurs in a way that limits risk. So one thing OG neglected to discuss is what the criteria are specifically for inclusion on the list and why this leads to that sorting. Our criteria is very specific. It is systemic importance, which means it is an objective evaluation of the bank's market cap, i.e. how much of the market they exist, and who they lend to, i.e. the indicators that tell you if that bank failed, how much of a risk they would be to the health of the overall economy. What this means is that on our side of the house, we can impose onerous restrictions on bigger banks. Those bigger banks are the ones that are able to be able to levy or to bear those costs. Banks like Bank of America, etc. But the sort of medium-sized small banks that opening opposition was so concerned about, on our side of the house, now have an incentive to be a bit smaller or to limit their size in order to avoid those onerous restrictions because they simply can't bear those in the same way. This leads to 2 good things. First of all, on our side of the house, it means that you make contagion, i.e. when banks can't lend to each other and those banks fail when one bank fails before it, less likely, because it means that there's less concentration in the banking industry when you have more banks limiting their size such that if they do fail, they're just not as important to the overall economy. Second of all, we think that those smaller banks now have an incentive to actually correct their behavior, to take less of the bad behavior that opening opposition identified. Because now it's the case that once you have that sorting, if you are a smaller bank, you know definitively that you will not receive a bailout, which means you know definitively that that risky behavior in the worst forms directly impacts your bottom line. To OO's point that says that these banks now have an unfair advantage, we say 2 things. First of all, it is clear we've already demonstrated it's better in some ways for those smaller banks. But second of all, even if there's like some unfair advantage between market entrants, we don't care, because the thing that we want is the ability to make a financial system that sorts itself in a way where if you do fail, and this is the choice that banks make, you are too small to make an impact on the economy. And if you are big enough to make an impact on the economy, we are subjecting you to those regulations. Now, the second thing that on prevention is politics. So the thing opening oppositions say here is they say, we will caveat certain regulations like liquidity standards that were really good here. So OG responded to this. We think they're kind of obvious. We'll deepen the analysis in 2 ways. So the first thing is to say, opening opposition probably should have explained if they wanted those regulations, but simultaneously made the argument that these big banks have huge lobbying arms, why they would actually get those regulations. We tell you, you will only get regulations if you give the big banks something in return. Clearly, on our side of the house, we do, because it is the assurance that you will be bailed out. But second of all, we say that the warrant for why political spotlighting is much better on our side of the house, that goes beyond what just OG asserted, is that the reason why politicians right now don't pay enough attention is that taxpayers, we think, simply cannot internalize the ethereal cost of paying billions of dollars somewhere in the future. The difference is on our side of the house, that number is much more real, much more concrete. When you can literally look at the billions of dollars you will pay to Goldman Sachs, Bank of America, etc., as a result of this bailout, it becomes much more real for you, which means you're much more likely to take that into account when making political decisions. On our side of the house, then that is why we think that politicians are more likely to get that regulation, which opening opposition already said was super important. No, your time's over. Cool. The second thing on politics is to say, we also think that we make the specific threats to the economy that originate crises, things like bubbles, less likely in the first place. Because we think that when we have voters that can internalize that cost, they are more likely to hold politicians accountable so that they don't direct bad economic policy. A good example of this is in 08, or excuse me, after the tech crisis, when Clinton wanted to find a new way to fuel growth, and as such had the Fed lower interest rates to incentivize home buying. We think that is exactly the sort of economic policy that led to the bad crisis in the first place, which is less likely to happen when voters and politicians that represent them now say, look, we take this into account, it's internalized, we're not going to let you get away with this. This is important because there's now an argument for prevention that is independent of regulations. That is to say, something that tells you that the economic conditions that lead to crises are less likely to be bad on our side of the house. Closing.
So the government itself was invested in the banks that have lost in the subprime crisis. How do you think that they're going to be able to foresee what is the actual risk in the product?
What are you talking about? These metrics are objective. You can look at the cap of the company. You can look at what banks they lead to, which is a measure of what the contagion risk for that particular bank. So I think we can clearly tell what sort of banks would actually be the ones that should be on this list. Cool. Now, in solving the crisis, which perhaps also gets to your POI, we think we have three mechanisms. Again, none of them talked to by opening government. So the first is contagion. We think contagion, which is, again, banks lending to each other and cascading failures as a result, is actually more important. In modern crises, the things that cause multiple banks to fail is not bank runs, as we saw in 08. That would have been a good argument after the Great Depression, but the fact that contagion occurs when banks are not able to lend to each other. We make that specific source of the risk, the most important one, less likely on our side of the house, because it means that banks can more securely lend to each other when they know that those banks will be bailed out. That security is a unique benefit to our side. But second of all, we say that FDI, foreign direct investment, is much less likely on your side of the house, because creditors know on your side that it's not likely that they will get paid back when it comes to a crisis. We literally guarantee that they will get paid back, which is why it's much more secure for them. That's important because it means that it is literally a huge source of the economic growth, the things that both opening half teams say are super important in times of crises to inject capital into that economy, and we tell you that's what we get on our side. The third thing is we also think that banks bet on our side pursue better strategies for risk. That's to say, it is good when we encourage some risky behavior, quote unquote, risky behavior on the part of banks. That is good, for example, when smaller banks in Italy, which doesn't have asset price bubbles, are able to make loans to people that need housing in times of economic crises. We think those are beneficial policies that banks can pursue. But on their side of the house, they are disincentivized from pursuing those policies because it means that you're putting regulations on banks that would not otherwise be affecting the health of the economy, but can be making these sorts of important decisions that are to some extent risky, but ultimately beneficial for the economy. That's another way in which they get bad behavior on their side. Cool. Now pricing. On our side of the house, we think more information is simply good. That's to say, we rebuke the idea that all risk is simply bad. So first of all, the people that are affected in this case are depositors, investors, people whose money will literally dry up as a result of the banks failing. So we think in this particular case, when on our side of the house, we bail out the banks, we recapitalize them, those individuals are much more likely to take risk into account accurately. What we mean by that is that on our side of the house, when bigger banks are subject to higher restriction or regulations because they know that those things are safer, they can no longer demand in that market higher interest rates as OO asserts because they know that those are the banks that are incredibly safe. By contrast, the competition actually benefits small banks because they now are competitive by by those higher rates because they know that they are able to they have higher risk and as such should be paying those higher prices to investors. That is good because I'm just going to do this, but I'm going to humanize those people for a second. The people that we are talking about, which like people have a tendency to do econ rounds, are real people. They are pensioners who derive huge benefits from the economy. When there's accurate pricing, risk is not bad. We let people make decisions. Sometimes people have more of an appetite and sometimes less. But when they know it accurately, they can take that into account in driving economic benefit for themselves. And that's what we get by accurate information. Huge benefit. We're proud to propose.
Thank you very much. And now the member of the opposition. Here.
Dear panel,
we get a great case from opposing opposition on why we get worse risk taking, why we have more crises, and so, more a chance of crisis, and so on. Opening government given the two challenges to this. One is they say in the closing our government as well, this enables us to regulate those banks significantly better, therefore preventing crises. Secondly, they tell us that the assumption today is that banks will get those bailouts, and they actually are likely to get them, and therefore we're actually creating a much more certainty within the market. What we're going to extend on it is specifically with answering those two challenges, explaining firstly why regulation is inherently not going to solve these sort of crises. Therefore, the incentives you provide make things significantly worse. Secondly, we're going to touch on something that hasn't been discussed before, which is how governments actually manage the crisis when it's already begun, and why you get significantly less flexibility and less vulnerability to manage it. Before that, a few extraneous points of rebuttal to just a lot of material we just got from CG. So firstly, they tell us, firstly, just to be clear, we can make different regulations for banks that are small and banks that are big. That has no inherent relation to the question of whether we should bail them out. So everything they say on that is simply outside of this debate. We can agree that regulating them differently is okay. Secondly, they tell us there is now an incentive for banks to not to get as large as possible. A few answers. First of all, they have a clear incentive to do it, given that they get a lot more insurances to their investors, meaning they get a lot more. They get significantly more power within the market. They get significantly more investment because they're now a much more safe investment. Therefore, we say they still have a great incentive to do that. You even increase their incentive to become larger banks. Secondly, note that if this analysis is correct, and what actually happens is they are still likely to invest in the same things that the large banks are investing in, because those, as opening opposition already analyzed, those things are perceived to already be secure investments because the government will bail them out. That means that there is actually not much difference between having a lot of mediocre banks and big banks, given that they are all investing in exactly the same things and exposed to exactly the same risks. Therefore, we say that you could look at it as just one big bank with the same risks, just according to them, probably worse regulations, because this is what they're supporting on their side of the house. Thirdly, they tell us, but now the price of bailouts becomes more realistic to voters. First of all, note that, for example, the Department of Defense budget is also available to voters, and it's $500 billion a year. However, we don't see a lot of criticism on that, as long as people don't see the actual impact. Secondly, note that this is a very weird claim on their side, given that it has to mean that people will now criticize that investment and therefore create less certainty with regard to whether they'll actually get bailed out, which is what they want to achieve on their side of the house. We simply don't think that analysis works. Let's talk about why regulation is not likely to be able to solve these crises. So we have four issues that we need to be discussed here. First of all, the fact that they have the effect of political power, lobbying, the revolving doors they have with regulators. All these things mean that there is a clear incentive to lax regulations, especially in times that are not crisis times. That means that when everything is good, there is no incentive for the regulator themselves to steer things up. There is no, and there are quite a few incentives for growth. Secondly, note that the government incentive itself is also for growth. That means that the government, as the one operating the regulator, has the same incentive as a bank in a time that is not a time of crisis. Therefore, we say again, a very bad incentive for governments. As we point out in APOI, the government had most of the same bad investments that banks had during the financial crisis. We don't think governments are just good at regulating those things. Which leads us to a third issue, which is the structure of investment done by financial institutions in a globalized world is one where they are so vast that in order to track each and every one of them, and this sort of creates a tax rate, you would basically need another bank to just do exactly the same thing and apply regulations on all those transactions. Note that banks have a clear interest to do that themselves because they don't want to be exposed to bad investments, and they have that same incentive. We simply say a government regulation on this is unlikely to solve it. And fourthly, we honestly don't know where the next crisis is going to come from. We don't know in what sector it's going to be. We don't know in which industry and how it will play out. Therefore, again, government is not a very good agent as well in order to regulate those specific risks. So we're saying the solution of regulation just doesn't work. Yes, Smith.
Assuming what you're saying is right, and this bailout is such a huge boon for these financial institutions, can you tell us why can't we leverage that in order to impose those financial regulations as opposed to the comparative?
Okay, great. Thank you, Mifta. I'm going to explain exactly that about leverages, going into that right now, because when we talk about how we actually manage the crisis itself, because opening government tells us they're going to get a bailout eventually, because in crisis, the government uniquely needs those institutions. Note, that's actually the other way around. Specifically within a situation of a crisis, the banks need the government significantly more than the government needs the banks, because that is the situation in which they are most economically weak. Therefore, the government has significantly more leverage over them. That's the first issue. But secondly, note that we and note that obviously they tell us, but the government needs to solve the crisis generally. Note that solving the crisis generally doesn't necessitate a specific bailout to a specific institution. Therefore, the leveraging power is in the hands of the government, in the ability of we can bail you out or we can bail you out, and now you fight among yourselves on who gives us the better conditions that we need. Therefore, they have significantly better leveraging against those institutions on our side of the house. Moreover, you have moreover, we're saying that generally speaking, you don't know, as we said, where the crisis is going to come from. Therefore, you do not know which institutions are going to be the most critical in order to solve that crisis. Therefore, that means that publishing a list in advance just significantly limits your capacity to actually respond in an efficient manner to the crisis when it emerges, because you may need different scales of investment. Maybe a bailout is not a good idea if an institution is significantly sick, in a way that you know what, sometimes those institutions are better off if it's better off for the economy if they collapse. We're saying that given that bailout is a complex economic debate in and of itself, and the government is much better positioned to make that discussion when they already know the situations and the terms of the specific crisis that they are now responding to. That is significantly better way. We say simply that that government decision is much better made when they're at the situation where they already have significantly more information and they have better leveraging power with regard to those financial institutions. Then they tell us, oh, but we need trust, we need investor trust, we need to regain that. So we say, first of all, why? If we don't want investors to invest in something that's in a very bad investment, we don't want trust for specifically that. Secondly, we say that if they tell us that there is a significant level of trust that some bailouts will happen, then we say those investments that they're talking about are still likely to accrue to some extent. We're saying we just make it too easy to make bad investments. Extremely proud to oppose the motion. Thank you very much.
Thank you very much. And now the government whip to close the case for the government. Here.
Cool. Everybody ready? Risk is not actually a dirty word, nor should it be in this debate. Risk is not the problem. It is the inaccurate pricing of risk that leads to everyone in financial systems being worse off that is the problem. Interestingly enough, what we have on the opposition side of the bench is an opening team that won't take any risks. So they don't even want small banks making mortgage loans to people who need houses. And then on the closing half, they want governments to use the leverage and the power, you know, kind of like Trumpian bargaining tactics, when people's literally the entire economy and financial institution hangs in the balance. On side closing government, what we stand for is the fact that accurately pricing risk leads you to make investments where you should, to make sure safety and stability of the economy is always maintained. 3 areas of the debate. First, I'm going to talk about who has fewer crises. Second of all, I'm going to talk about who responds to crises better. And finally, I'm going to talk about the broader economy. First, on who has fewer crises. We get a challenge from opening opposition that is unresolved at the end of the top half, which is the fact that there's going to be political bargaining in who gets to be a part of these banks. Like, guys, this is not some shadow dealing room, right? Like, there are already lists published by the IMF of systemically important financial institutions, right? This is all incredibly contestable. You can literally just take out a threshold of the percentage that the bank captures of the market, say this is the threshold, and above that, we will secure them, right? So we think even beyond this, voters have a huge incentive to check against this because unlike the military, as Ayal talks about, people don't like banks, right? So voters will be very happy to do this. Great. Second area of this is Henry and I uniquely explained to you why one of the biggest causes of huge crises we prevent, and that is having a consolidation of a ton of big banks, right? Why is that a problem? The reason that that becomes a problem is because if something happens, even if it's short of needing to be bailed out, it leads to contagion when lots of people have money flowing through them. And as a result, more and more actors are hurt, more people lose their jobs, more firms can't produce, all of those bad things that I think are pretty intuitive. How do we solve these? We say very large institutions like Bank of America, places like that, they get a lot of benefits from being huge, right? So they're probably going to stay in that position, take the security that they get from this policy, and accept onerous regulation that I think very obviously is going to be the price of such security. But medium-sized banks that can't compete at the level of Bank of America have to find some sort of niche in the market. What this does is it literally gives them a competitive incentive to become smaller and as a result less risky. So if they go down, they don't tank the economy, they don't tank other banks, and as a result they get a competitive advantage, contrary to what OO says, because they're not hit with unbelievably high ratios of assets to liabilities on their balance sheets, which allows them to make more loans, make more money, and pump up their profitability. Co-opting any response before it comes out. We don't think this is going to lead to small banks being too risky, though, because unlike the status quo where they think they might get bailed out if something goes wrong, they absolutely know for sure that they won't. So they're not going to become so risky that they ever pose a problem. No. Next area is why we actually get good regulation. Opening government tells us that there will be a political spotlight, and I think that's true. Some politicians that are already pro-banks will now have more power. We give you 3 other actors that will join in this fight. First of all, voters. I've already told you, unlike defense spending, which people like generally because they like the military, and also it's budgeted into every year, people really hate banks, right? Sorry, Michael, but people don't like Goldman Sachs. And also, these are huge sums of money that are not taken into account of the budget of the government constantly. So it makes a really big deal in terms of spending of other things. So we think voters will have a huge incentive to push for these types of regulations. Other people that will do it are small banks themselves, right? Because they only get the benefit competitively if there are onerous restrictions placed on big banks. The response we get from closing opposition is that banks, banks will always want to be large because they get security from it. So as I already explained, some of them can't ever compete with Bank of America because they're not that large. So as a result, if it's a choice between the two, given the high cost of getting larger and larger, it's in their economic incentive to spin off assets and instead break up into smaller banks. But then we hear that they can just have regulation for different size banks. Like, guys, you can't just fiat this, right? Give us some arguments for why it's likely to happen. We think when you actually align the incentives of all banks to lobby against these types of regulation, it's far likely that you ever get this. No. But finally, we tell you that bubbles that actually cause crises, things like purposefully lowering interest rates to find new sources of growth after the tech bubble, are less likely to happen because voters, again, see the exact price tag of what that crisis actually means for them. No, not right now. OO on this says that small banks will become too risky. This doesn't happen because they know they won't be bailed out. CG says governments can't regulate banks because they have the same investments as them. Like, maybe my memory is wrong, but I don't remember the US government initiating subprime mortgages. But also, like, if governments can't regulate banks, that happens on either side of the house, right? The difference is that we empower other actors who actually push for the type of regulation, small banks who actually understand what the financial climate looks like and understand the assets that are in possession opening.
On your side, smaller banks have to necessarily reduce risk-taking. Big banks can increase risk but have no incentive to offer competitively better returns to their customers. Who is this policy even good for?
Yeah, so it's good for depositors, it's good for investors, it's good for small banks who have a competitive rate, it's good for homeowners who don't get a huge bubble, like tons of people. Great. Second area of the debate, responses to crises. So first of all, another unique and very important contribution from closing government is the fact that banks finally lend to one another when some sort of crisis occurs. So one of the huge problems in 2008 is that one bank would go under, they wouldn't have good information about it, so then they wouldn't be able to pay back loans to other banks, or nobody would lend to banks because they didn't have an assurance of their security. On our side of the house, when small problems occur, banks are more likely to lend to systemically important banks because they have an assurance that they will always be paid back. That's hugely important. CO is a little bit ballsy here. They're just like, during crises, government has more leverage, so as a result, they should just take a risk and use that leverage. Like, are you serious? When the stock market crashes, you don't think the government is going to get screwed just as much as the banks are? Like, come on. But also, even if this is true, that has serious consequences if miscalculation, right? These are people's lives, jobs, pension funds. Like, don't let this just be numbers on a page. That risk appetite is not something that you should actually be buying into, because that has consequences. Final area of the debate, broader economy. We tell you that more information gives you a better market. We think it's unfair to investors who don't actually know now whether or not the bank the investment would be bailed out, whether or not they face the chance of a bail-in evenly. As a result, we get more capital allocation when people actually understand what they're buying. But finally, small banks don't get foisted with tons of onerous regulation that prevents them from making the loans that drive the economy. Very, very proud to propose.
Thank you very much. And now the opposition whip to close out the case for the opposition bench and indeed, genuinely regrettably, the debate as a whole. Hear, hear.
Okay. Let's be very clear on what is happening in this debate. There is an impasse at what has happened in the top half. Look, opening government tell you the following thing. We are fine with doing it in order to gain regulation that are going to be able to prevent the next crisis. The opening opposition tell them, but look, regulate anyway. Here's the issue of the response of the opening opposition. It also answers the case of the opening opposition. Why is that correct? Because if we are able to regulate them anyway in order to make sure that they're not going to take big risks, then the challenge that they get from POI, from the closing government that says, look, what we essentially want is to prevent the huge monsters that are going to be created in order to take exactly these risks. So just use the exact same regulations on the banks that are now bigger. So there is an impasse here on what is actually happening, which matters, because look what our case essentially solves. If we're able to prove that inherently regulations under these conditions is something which is not possible, all of the rest of the case of the opening opposition as the concentration, as the risk incentives is something that we cannot do, but now we're going to create a market which is much more vulnerable to crises. We solve exactly that which prioritize above opening opposition. Moreover, look as an opening government. Secondly, look, we don't actually, and this is something Evan May says, have to be against bailouts in every single case. We just say that specifically when something is already happening, we have more information. Something to note here. In many cases, we don't know where the next crisis is going to come. Yes, the government may have not directly invested in subprime, but they did put the pensions of the teachers in them. In many cases, we simply don't know where we're going. The next crisis is going to come. It was commodities later on. It was commodities later on. It was the high tech in the early 2000s. Simply economics, unfortunately, is not a science. Let us continue. What is IMF? Yes. Okay. Why they're likely to inherently fail at this? Firstly, look, as said, empirically, they have failed in the past. This is something which is torn. Secondly, look, the government is going to have interests aligned with the bank. Every time, and this is the rule of debating, when you're claiming a market failure, what you should prove is there is not greater government failure which is going to come attached to it, which is essentially something that Ayal explains to you, and Evan doesn't really respond. What he says is that everyone who is elected towards government, which is assuming the people who are going to follow this directly and have the more information, also have a short-term incentives, like the CEOs themselves, because they want growth, they want the GDP to grow higher, they want to make sure that more money is going to come, and therefore it just means that they're not likely to push and make sure the regulations are even going to pass. This is something which matters. Voters do not know how to usually regulate this. Like, people are going to vote with it because they hate banks. Look, I hate Burger King. It doesn't mean that I know what they have as the components of their burgers. We simply don't understand this logic. Okay, let us also say, what is actually the rest of the case in terms of separating us from the opening opposition? Because now you understand what is the issue of concentration. Because now, when you get a skilled market and other people are likely to follow, and the government is not likely to put the brake in time, everyone is going to copy the investment investments of the big bank. Note, here is the necessity of specifically our case to that, because the challenge they get from closing government is it might not be as bad if people are going to follow them, if these are better investments. Here is what we prove to you. If you cannot regulate them, and even if you're going to be able to have the fiat to place the regulations, they're not going to matter. Therefore, now the entirety of the market is going to follow on bad risks. Everyone is going to be significantly more vulnerable. But we don't only stop there. We simply say that we're going to have a significantly greater fiat on actually applying what is better for the public and for the vulnerable people, which, correct, people are vulnerable, but what we want to make sure is they're going to be less comparatively on both sides of the house. It's not the bottom line of this point. And if we are going to make sure that sometimes they're going to be exposed, the fact that we have the threats to make sure that some of them are going to close down, like the stealth eventually did happen, like that. I think Merrill Lynch, but let us not Merrill Lynch. Fine. So the other banks that collapsed, Lehman Brothers. That's the one. Okay. So the other banks that collapsed is what enabled later on to make sure that they're going to get the money back, to make sure that we are going to be able to have a stake in them in order to see how they're going to be distraction. We simply say that in many cases it is better. But thirdly, look, we simply say that sometimes in some crises a bank can collapse. Why? Because if the crisis is not targeted at financials, let's say that the crisis comes from the high-tech industry, and this is something that does something wrong, we want them to be one of them to collapse, even if they are great. Opening.
So if the government is incompetent in bed with the banks or in a state of political panic during the times of crisis, even if they have the information post-crisis that you say, one would simply think that they will be able to have.
We simply say no. A comparative. Firstly, more information which is available to a specific crisis. Secondly, the public, if by logic, is much more aware to regulate them within crisis. Thirdly, the leverage is significantly greater within crisis. We simply say that essentially only thing that is happening here is because we're unable to make sure what is going to be the bottom line and how the regulations are likely to work, even if they're going to be implemented, they're going to use the magnificent political capital of making sure that we have a safety net in order to do that. You're just creating something which is going to, sorry for the word, fuck up the entire market. But to be fair, I even want CG. Yes, Evan.
Yeah, great. So maybe you have more information and flexibility when you have to banks to bail somebody out. But because you have more bigger banks and because banks don't lend to one another, now you have to bail out 20 banks instead of only
No. We simply disagree. Firstly, so banks have an incentive to grow up regardless. So we simply don't accept that we're going to have a significantly larger amount of debt. But secondly, look, if your entire issue at the end of this debate is only going to be an issue of liquidity, so make sure that if a specific crisis is going to be a crisis of liquidity, make the market liquid again. We simply say that this is simple as that. The fact that banks can lend to one another, and the fact that they are able in some cases to do this, doesn't mean that every crisis is going to follow exactly that. In the crises which are not going to follow this pattern, the structure is significantly worse, because if one bank have lent to one company and they do not follow that, the other banks are not going to be in trouble. All that it says, look, now you're going to have to lend to 20 banks. The fact is, when you collude them together, even the smaller banks, now you're going to have to lend to hundreds of banks, right? Because even if each and every individual bank can collapse, the fact that they're going to tie up their investments with the bigger ones, even if they're separate actors, make them one huge bank. So this is something which shows you why we said we're going to have to lend to significantly more under their side of the house if this is something which is going to pass. Look, essentially this is what our case does. It tells you that even if the magical case from the opening government is going to be able to be proved, this is something that we simply cannot do. Therefore, the competition on the comparative is something that is going to ensure that risks are going to be more spread, therefore we're going to be much less vulnerable in extension. We close the gap on why this is something which we inherently cannot do, which fills us and prioritizes above opening opposition, and we simply say that the incentive structure that is created just shows you that we're going to have much less liquidity and flexibility comparing us to closing government. We beg you to oppose.